Hey traders, and welcome to Technical Edge. Let me be brutally honest with you. If you can't read market structure, you will not survive in trading. It's that simple. Market structure is the first and most crucial skill every trader must master. It's the difference between random guessing and consistent profits. And today, I'm breaking down 4 essential hacks to mastering market structure. Hacks that most beginners overlook, but every serious trader needs to apply the moment they sit behind the charts. Plus, I'll share some advanced structure mapping tips that can put you steps ahead of the market and give you the same clarity elite traders use. So do yourself a favor, watch this video all the way through. And if you're new here, don't forget to smash that like button, subscribe, and join the Technical Edge family, where we turn beginners into disciplined traders. All right, let's dive in. The most important concept and hack in market structure analysis is identifying the current trend of the market. If you misread the trend, every decision you take will be against the flow of money, and that's how traders blow accounts. But if you align with the trend, the market literally carries you to profit. As traders, one of the first lessons you must learn is this: the market only operates in 2 main conditions. That's it. It's either trending or consolidating. If you can read these 2 conditions correctly, you're already miles ahead of most traders who keep guessing. A trending market moves in 2 directions, either upwards, which is called an uptrend, or downwards, which is called a downtrend. So how do we differentiate an uptrend from a downtrend? Let's dive in. An uptrend is when price is moving higher and higher over time. The way we recognize it is simple. The market forms higher highs. Each peak is higher than the one before. The market forms higher lows. Each pullback doesn't fall as low as the last one. Think of it like climbing a staircase. Every step takes you higher, and even when you pause or step back a little, you're still standing above where you were before. Now, let's look at the opposite, the downtrend. A downtrend is when price is moving lower and lower over time. And just like the uptrend, we can recognize it with a very simple formula. The market forms lower lows. Each new bottom is lower than the one before. The market forms lower highs. Each rally upward fails below the previous one. Think of it like walking down a staircase. Every step takes you lower, and even if you climb up a little, you're still standing below where you were before. This shows that sellers are in control. Every time buyers try to push price up, they run out of strength faster, and sellers take over again, driving the market down. Now that we've covered trending market, let's move to the second condition of the market, consolidation, also called a ranging market. Unlike trends, where price moves clearly higher or lower, a ranging market is when price gets stuck between 2 levels, support at the bottom and resistance at the top. Let's look at the concept of ranging market on line chart. Here price is moving sideways without momentum. It moves up a little and retraces back, indicating both buyers and sellers are not in control. It's almost like the market is trapped inside a box. Price bounces up and down within this box, but it doesn't break out in either direction. This usually happens when buyers and sellers are evenly matched. Buyers push up, sellers push down, and the market keeps repeating this cycle until one side finally wins. Unlike the uptrend, which we will observe in this line chart, price is moving upward without the pullbacks breaking the higher low of the previous valid structure break. Same concept in the downtrend. Price is moving downwards without the pullbacks breaking the lower high of the previous valid structure break. All right, traders, now that we've nailed down trend direction, let's move to the second hack of mastering market structure, understanding pullbacks. If trend is the foundation, pullbacks are the doors that give you entry into that trend. Without mastering pullbacks, you'll always be late to the party or chasing price at the wrong time. So what exactly is a pullback? A pullback is a temporary move against the main trend. It's not the end of the trend. It's just the market taking a short pause before continuing in the same direction. Imagine a runner sprinting uphill. They can't just keep running without stopping. At some point, they slow down, catch their breath, and then continue higher. That pause is exactly what a pullback looks like in the market. How pullbacks work in different trends. 1. In an uptrend, price pushes upward, then pulls back slightly before creating a higher low. This pullback gives you the perfect chance to buy at a better price, instead of chasing the market at the top. 2. In a downtrend, price falls downward, then pulls back upward to form a lower high. This is the golden opportunity to sell at a discount, before the next wave of selling pressure continues the trend. 3. In a range. Pullbacks happen, but they're usually small and tricky. That's why many pros avoid the middle of the range and just wait for the breakout. So how do we spot valid pullbacks in the market? To spot a valid pullback in the charts, we use pullback candles. So what is a pullback candle? A pullback candle is a candle that doesn't break the previous candle high when in an uptrend or previous candle low in a downtrend. So what are the rules to spot a valid pullback candle? Here are the rules. 1. The pullback candle must not break the previous candle's high or low. If the market is in an uptrend, the pullback candle should not break below the previous candle's high. If the market is in a downtrend, the pullback candle should not break above the previous candle's low. 2. The highs and lows are what matter, not the candle color. A green candle, a red candle, it doesn't matter. What matters is where the wick stops. If it respects the previous range without breaking structure, it's a valid pullback. 3. Always compare with the highest or lowest point in the current swing. In an uptrend, check that the pullback does not break the swing low. In a downtrend, check that the pullback does not break the swing high. This ensures you're trading with the trend, not against it. If the pullback breaks a swing low or swing high, it indicates a change of character, indicating a possible reversal. 4. Valid pullbacks equals safer entries. Chasing the market often means you buy at the top or sell at the bottom. Waiting for a pullback allows you to enter closer to support in an uptrend or resistance in a downtrend. Now let's move to the third and last hack. Understand valid ranges or structures. If you don't understand structure, you'll always be lost in the market, no matter what indicators you use. Because structure is the language of price. It tells you who's in control, buyers or sellers, and where the market is likely to move next. So, what is a valid market structure? A valid market structure simply means the price has created a clear sequence of highs and lows that follow a logical pattern, either upward, downward, or sideways. But not every high or low is valid. Let's dive into the basics of a valid structure in an uptrend. To identify a valid structure in an uptrend, here are the 4 rules. 1. A valid structure must have a major high and major low. As you can see from the diagram, price is continuously making highs and lows. It experienced an upward movement before it started to retrace. The highest point price reached before the retracement is called the major high. Also, the lowest point before the movement to the upside is called a major low. These points mark the turning points of the market. Without them, you're just looking at random candles. 2. The market must show a clear sequence. In an uptrend, each new high is higher than the previous high, and each low is higher than the previous low. The market breaks the previous higher high while holding the lows. The uptrend ends when price breaks through a higher low. So in an uptrend, it is important that price doesn't break through the higher lows. If prices breaks through the higher high, it forms a break of structure. Being able to spot valid structures in an uptrend is significant to avoid falling into traps or being used as liquidity by the market. 3. Break of structure, BOS, confirms that the trend is continuing. When the price breaks above a previous swing high, the BOS is your confirmation that the structure is valid and the trend is continuing. So how do we spot valid break of structures? 1. Price must break through the previous higher high with a candle body and close with the body of the candle above the higher high, not a wick. If price breaks through a previous swing high with a wick, it is not considered a valid BOS. 4. Respect for the previous structure confirms validity. After the BOS, if price comes back and respects that broken level, turning it into support or resistance, it confirms that structure is valid. In an uptrend, the old resistance becomes new support. So now let's move to the opposite, the downtrend. To identify a valid structure in a downtrend, here are the 4 rules. 1. A valid structure must have a clear lower highs and lower lows. A lower low forms when price makes a dip to the downside. It is the lowest point price gets to after causing a break of structure and forming a pullback. These points mark the turning points of the market. Without them, you're just looking at random candles. 2. The market must show a clear sequence. In a downtrend, each new low is lower than the previous low, and each low is higher than the previous low. The market breaks the previous lower low while holding the lower highs. The downtrend ends when price breaks through a lower high. So in a downtrend, it is important that price doesn't break through the lower high. If prices breaks through the lower low, it forms a break of structure. Being able to spot valid structures in a downtrend is significant to avoid falling into traps or being used as liquidity by the market. 3. Break of structure, BOS, confirms that the trend is continuing. When the price breaks above a previous swing low, it confirms bearish strength. The BOS is your confirmation that the structure is valid and the trend is continuing. So how do we spot valid break of structures? 1. Price must break through the previous lower low with a candle body and close with the body of the candle above the lower low, not a wick. If price breaks through a previous low with a wick, it is not considered a valid BOS. 4. Respect for the previous structure confirms validity. After the BOS, if price comes back and respects that broken level, turning it into support or resistance, it confirms that structure is valid. In a downtrend, the old support becomes new resistance. That's it for today, traders. If this video gave you real value, make sure to subscribe and turn on the notification bell so you never miss the next drop. Share your thoughts or the next topic you want me to break down in the comments. Your support keeps this channel growing, and I appreciate every single one of you.